Okay, so picture this. You grow your revenue by over 600% year over year, your margins are expanding, and your reward is a staggering $100 million net loss. Welcome to Earnings Unscripted. Today is March 25th, 2026, and we are unpacking the Q4 2025 results for Ondas Holdings, ticker ONDS. And Miro, this one is just a giant optical illusion, isn't it?
Yeah, it is. It's an $82 million optical illusion, to be exact. If you just scan the headlines, it looks like they burned a crater in the balance sheet. But the core operations are actually running incredibly hot. That net loss is almost entirely driven by a non-cash warrant revaluation charge.
Right, because if you strip out that accounting noise, the actual business is surging. I mean, top line came in at $30.1 million. That's, up 198% from just last quarter.
And gross profit hit $12.7 million. That pulls margins up to 42%, which is a massive lead from the 26% we saw in Q3. But of course, the market didn't really care about the gross margins. They saw that diluted EPS hit negative 27 cents and just hit the sell button.
Yeah, an immediate intraday sell-off. The stock dropped over 5% during regular trading, closing down at 1031, which, by the way, before we dig too deep into that price action, quick reminder that this podcast is strictly our personal opinion and definitely not financial advice. So please do not trade your portfolio based on our banter.
Fair point. But honestly, the tape reaction makes sense if you only read the footnotes. What actually matters here is what Ondas is doing. They used to be known mostly for wireless rail networks and some drone tech. Now they're aggressively scaling up.
Oh, aggressive is an understatement. Armed with a newly pre-funded war chest, they just dropped roughly $550 million in Q1 to acquire 5 different defense companies. They are trying to stitch together air, ground, and space assets into one unified operational grid using Palantir's AI.
It's an incredible pivot. And one of those acquisitions, Worldview, brings in this fleet of high-altitude balloons they call Stratollites. It solves that persistent surveillance gap between temporary drones and low Earth orbit satellites. But the physics of how they steer them is actually brilliant.
Yeah, I loved this part from the call.
Right. So these balloons sit in the stratosphere for up to 30 days. They don't have standard propulsion. To steer, they basically just pump air in or out to change altitude, and they catch different directional wind bands. The CEO called it making a vertical decision to create a horizontal result.
A vertical decision for a horizontal result. I love that. It's so deeply poetic for a defense contractor.
It really is. It's elegant engineering, but engineering is one thing, and integrating 5 acquisitions while managing your balance sheet is another.
Exactly. They have the balloons, they have the AI, and they definitely have some accounting noise. All right, let's get into the details.
You say details, I immediately look at the plumbing, because dropping $550 million on 5 companies is, well, it's actually the easy part. The hard part is post-merger integration. You don't just staple 5 distinct tech cultures together and hope for the best.
Right, especially when they're literally spread across the globe. You've got Israeli defense, British aerospace, U.S. balloon tech. It's a logistical nightmare waiting to happen.
Exactly. But I think they are being surprisingly surgical about how they localize it. The thing that stood out to me in the filings wasn't the balloon physics. It was this tiny joint venture called Onberg.
Oh, yeah.
51% owned. They partnered with Heidelberger, the German industrial group. Why is that the piece that catches your eye?
Because it solves the biggest bottleneck in European defense contracting. Look, European governments are intensely protectionist right now. They want sovereign manufacturing. They don't want to import American or Israeli black boxes. They want it built in their backyard.
Oh, so Onberg is basically a passport. They're stamping their tech with a Made in Germany label to bypass the NATO procurement red tape.
That's exactly it. It's regulatory judo. They get direct access to EU defense dollars without spending years building indigenous manufacturing from scratch. They just piggyback on Heidelberger's footprint.
Okay, that's clever. That actually is very clever, but it still brings us back to the whole stapling things together problem. You have German-built drones, high-altitude Stratollites, ground sensors. How does an actual military commander use that?
because right now it just sounds like 5 separate screens in a control room.
Yeah, and that's usually how these things fail, the isolated asset problem. But that is where the Palantir partnership comes in. Ondas signed an active commercial deal to use Palantir's AIP and Maven platforms as their central nervous system.
Right, the AI software layer.
Yes, and Ryan Hartman from Worldview said something on the call that really crystallized this. He said the operator should not have to care which domain the data came from. The operator should care whether the decision is right, fast, and accountable.
Which completely flips the narrative. I mean, if you look at it that way, Ondas isn't really a drone company or a balloon company anymore. They're a data broker. The hardware is just a very expensive vacuum cleaner.
A vacuum cleaner for intelligence, yeah. And the margin profile of data is totally different. Hartman actually explicitly said, data is the new oil. The more data you produce, the more customers you can create on a per-flight basis.
Wait, per flight basis. So one balloon goes up and they can sell that same intelligence feed to, maybe agricultural clients, weather services, and defense command all at the exact same time?
Precisely. You amortize the hardware cost once, and you sell the software output infinitely. But, look, I want to pull this back down to the ground, because the high-level theory is great. The reality of operating this beast is much dirtier.
Dirty how? You mean like actual dirt?
Literal dirt. CEO Eric Brock was talking about one of their acquisitions, Indo-Earth Moving. They make autonomous bulldozers. And he pointed out that the mechanics going out to service those massive dozers, well, they can be the exact same people servicing the unmanned ground buggies from a totally different subsidiary.
Oh, I see. So it's cross-training the service technicians. That is such a basic human detail.
It's basic, but it proves they are actually thinking about the messy operational overlap. It's not just bankers building PowerPoint synergies. It is, hey, this guy has a wrench. Let him fix both robots.
I love that. A guy with a wrench saving the compounding value flywheel. That really is the human side of all this M&A talk. But if they are spending all this money and changing the entire structure of the business, when does it actually pay off? So where does this leave them heading into the next quarter?
Management is basically saying the payoff starts immediately. They guided Q1 revenue to between 38 and 40 million. And for the full year, they are now projecting at least 375 million.
Wait, 375? Didn't they just have an investor day in January where the target was roughly half that?
Yes. They literally more than doubled their own outlook in 2 months. Eric Brock said on the call, this is not just a series of acquisitions. It is a compounding value creation flywheel.
A compounding value creation flywheel. Okay, that's definitely peak CEO poetry right there. But look, there has to be a catch. You don't scale that fast without breaking a few things. What are we watching for next quarter?
Dilution. And honestly, pure earnings noise. To fund all this, their share count jumped from 329 million to 467 million shares. So the equity is definitely stretched.
Right. The existing shareholders are basically bankrolling this entire defense prime pivot.
Exactly. And the CFO already warned everyone that the warrant liability causing this quarter's massive net loss, well, it will keep fluctuating with the stock price. So next quarter's reported EPS is probably going to be just as chaotic.
I mean, a casual investor is just going to see another massive paper loss on the screen and walk away.
Probably. But it looks like management is betting the year on pure execution. They expect these acquired product companies to reach positive EBITDA by Q3. If they actually hit that, the accounting noise fades. If they miss, market patience runs out fast.
Okay, so they bought all the coolest pieces and now they just have to build the spaceship while it is currently in flight.
Preferably without crashing it into their own balance sheet, yeah.
Fair enough. I think that is a fittingly complex note to wrap on. Thanks for unpacking this optical illusion with me, Miro. And thanks to everyone for tuning in.
Talk to you next quarter.
By the way, if you want these earnings breakdowns to just magically show up for you, make sure you're following the feed. We actually generate this podcast using AI to help pull the human stories out of the data, which is exactly how we can turn these episodes around so fast right after the bell. Let us know what ticker we should untangle next by emailing earningsunscripted@datamadness.ca or grab the X link in the show notes.
Catch you next time.